Top three things in my notebook this morning are the U.S. dollar, number one. Number two, the 10-year bond yield here in the U.S. And number three, the price of oil again, which continues to be paramount in our model. If you look at number one, the U.S. dollar, the problem with the dollar, of course, is that it is broken. I mean, from a trend perspective, that is, which is the most important line that matters. Yes, the long-term tail support for the dollar is intact, and that's closer to 79 on the U.S. dollar index. But the bigger issue here is that the U.S. dollar index's trend, which is 81.35 on the U.S. dollar index, is broken. So again, that's a leading indicator for growth slowing, number one. Number two, U.S. 10-year bond yields, in particular when agreeing with the dollar, so both are directionally pointing the exact same way. The immediate term correlation between the U.S. 10-year bond yield and the U.S. dollar index is now 0.98. It's almost 1, okay? So this is the point. Ben Bernanke has officially slowed growth expectations. So as 10-year bond yields fall in the face of the U.S. dollar having no bid, that is the leading indicator for growth slowing. So again, that's new, and that's why we're concerned, and that's why we have such a big cash position relative to where we were before Bernanke spoke just last week. Then finally, the price of oil, which would be the countervailing wind that could actually help us or hurt us. And again, I think Bernanke's as dangerous on this front as Syria. Just look at it for what it is. It was below its tail risk line yesterday of 108.57 on Brent, and today it's back above it. So again, with the price of oil, with Ben Bernanke in the backdrop, you cannot get too bearish on oil just yet. So again, we're going to wait and watch on this thing. No position in oil for now. With it above the line this morning, that's more bullish than it was bearish yesterday. So those are your top three things.